Hello, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I'm an adjunct professor, had a long accounting career and went back to school to teach. This lecture is for my accounting 3110 students. This is intermediate accounting 1, and the chapter is going to be revenue recognition. I am using the materials from the textbook, McGraw-Hill's textbook called Intermediate Accounting from Spiceland, Nelson, and Thomas. Great textbook. Again, highly recommend that textbook. So that I'm gonna get started. We're gonna talk about revenue recognition. Oh my God. Let me just give you a brief overview before we just get right into the slides. What is the most important line item on any financial statement? I've got to say that it is revenue. That is a big deal. If we're in a business and we're going to be a successful business, it's all about how much are we selling? What kind of services or products are we selling? And what we're selling gets recorded on the revenue line item on the income statement. It's the largest line item on the income statement. And we definitely hope that revenues are going to be larger than all the expenses in total, and then we're making money as a business. And so business leaders and management teams are evaluated on how much they're selling. What's the revenue line item? That's a really important deal. And so how we recognize revenue as accountants is also very important. And as you're going to see in this lecture, it can be challenging, not fun. Now, if you are doing accounting for a high-powered management team, what do they want to do? They want to record really high revenues, and they want to record it now in this accounting period. So one of the issues is not only about how much we're going to record, but when we're going to record it. Did the activity really happen in this accounting period? And we can record revenues now, like the management team wants, because they want to get their bonuses, or is it going to have to be deferred and recorded later, or maybe, as we will see, over time? And so let's look at these challenges. I'm going to share my screen and we'll get right into this. So here we go. Chapter 6 from the McGraw-Hill textbook, revenue recognition. Because I would say this for my students, and probably for all intermediate students who might, by happenstance, find this lecture on YouTube. This is where intermediate accounting starts to get difficult. Up until this point, a lot of it has been review of some basic concepts we learned in Principles of Accounting. We went through accrual entries, basic kind of measurements of accounting. We did the balance sheet, we did the income statement. Now we're going to go down some of the line items on the income statement and the balance sheet, and these are going to get a lot more challenging. I'll say right now, this is going to be a hard chapter. So let's get started with that. All right. Why is my little thing not working here? There we go. So revenues, we'll start easy here. Revenues are financial benefits to the corporation that come from one place, delivering our products. Either we're reselling products as a retailer, or we manufactured and produced products that we're selling. So it's selling products. Now we could be in a service business, and it's going to be selling services. Or there may be some other kind of activities for financial service firms. They're loaning money. So their big revenue is going to be interest revenue. So there's various and sundry different kinds of revenue, but it's all about what we are providing to our customers. And it's big questions. How much do we record? And when do we record it? This accounting period or the next accounting period? Now, there was just recently passed a new accounting standards update I forgot what year that was. I don't think in no chair, I guess, 2014. So this is only about 6-7 years old, because transactions, and it was getting very complicated how people were doing business, and the rules were rather fragmented. And I think the SEC even had some of their own guidance about recognizing revenue. So the FASB knew they had to do something. And it took several years, but they come up with some very clear guidelines in a more principled way to recognize revenue. And so I would say, let's see something here that would matter here. So the core principle here, there's two kind of components. When the goods are transferred to the customer or services, and also for the amount they expect to receive in exchange those services. So when, upon transfer to the customer, how much the seller is entitled to receive or expects to receive, if you will. We have 5 steps. Number one, we're going to identify the contract. That could be an oral or written contract between the company and the customer. And then number 2, what is it we're doing? What is the performance obligation that we're doing for our customer? If it's a product or a service, or is it multiple things? We'll see where there could be multiple performance obligations. And then, we have a contract, so the price must be known by both and accepted by both the customer and the business who's selling that product or service. If there are multiple performance obligations, then we've got to take that one price and we've got to allocate it between the various performance obligations. And then finally, we're going to recognize revenue when the performance obligation is satisfied. So pretty easy, pretty much common sense, and this, keep these core principles in mind as we go through the various issues we're going to see around this. So the contract is going to have the legal rights of a seller and a customer established, and it could be by a common understanding. It does not have to be a written contract. It could be an informal contract or an understood contract based on prior services or products sold or performed. And then here is one issue with the performance obligation I mentioned. It could be one, or it could be more than one performance obligation within this contract. And we'll look at some examples. Determine the price, how much a seller is entitled to receive legally. And that's true for both single or multiple, although in number 4, we'll have to allocate. If there are multiple performance obligations, we're going to allocate this. And then finally, number 5, recognize the revenue when the performance obligation has been satisfied by the seller. Now, here we have some issues. Is it just product sold and we recognize at the point of time? Are we, through the contract, providing a maintenance agreement, or we're renting a warehouse to someone? Maybe the revenue, the performance obligations are going to take a period of time to do, and we'll recognize that over the period of time. And then finally, there may be multiple performance obligations. We'll have to look at each performance obligation and determine, is that at a single point in time over a period of time, or is it, do we wait till everything has been done? And so we'll look at these kind of issues, and we'll look at some examples as well. So, what are some indicators that tells us, hey, we can recognize this revenue at the single point in time, and that's generally when we've delivered a product, a distinct product to the customer. And it could be, we know we can recognize that at that single point in time if the customer at that point in time has an obligation to pay the seller. The legal title has passed from the seller to the buyer, and the buyer has physical possession of the asset. And we'll look at that in some bill and hold transactions towards the end of this chapter. And this is a really important one here that's always been part of the rules, even the prior rules, that the buyer has assumed all the risk and the rewards of ownership. So if that product was destroyed by a fire, who has the risk for that? If the seller still has the risk for that, then maybe the risk and the ownership, rewards of ownership have not really passed, and maybe we should not recognize that revenue. And finally, the buyer has accepted the asset in the condition that the asset is in. Here's an example. So Tribox, a gaming console that sells video games individually, or it's a gaming module, and TrueTech is going to sell 1,000 Triboxes to comp stores. And then comp stores will resell it to consumers, I assume here. We don't know that. And so on December 20th, comp stores orders 1,000 of these at $240 each. And they promised to pay within 30 days of the delivery. So this is what I would call the order date. The customer has ordered the product on December 20th. Has Tribox done anything at this point? No, they have not delivered the product. They may have to even go manufacture the product at this point. It may not even be manufactured at this point. So the buyer has done nothing yet and gets to, no recognition of revenue, no entry whatsoever. On January 1st, 2021, TrueTech delivers all 1,000 of these boxes to comp stores, and the title to these boxes transfer to the comp stores. And it looks to me like comp stores have accepted these products, and now since they have physical possession of the products, they have the risk of loss. And so at this point, we do recognize revenue, and that's 1,000 boxes, 1,000 units times $240 for each unit. And so TrueTech is going to recognize and credit revenue for $240,000. Now, comp stores is going to pay later. So as we've seen in prior chapters, they're going to recognize an accounts receivable of $240,000. And finally, before the 30 days is over, TrueTech gets paid for these. And this is not a revenue date either. The main point of these 3 slides here is receipt of cash does not represent a revenue for the company. It's just a reduction of the asset, the accounts receivable asset. The sell and delivery of the product, that is the activity that we measure and recognize revenue for revenue at a single point in time. So here's an example. We're going to look at revenue over a period of time, and here's some of here are the 3 criteria that you would look at to decide, can this be done over a period of time? And note, it says if any one of these is met, then you're going to be recognizing this over a period of time. And so the customer consumes a benefit of the seller's work as it is performed. So maybe they have a cleaning service here, or maybe it's a computer maintenance agreement that companies would come and maintain your computers, or you're renting a warehouse over a period of time. Then if, let's say, the customer is renting a warehouse from the company, then they're using that warehouse over a period of time. They're consuming the benefit of that over a period of time, so we can recognize that revenue over a period of time. Second one, if the customer controls the asset as it is being created, for example, constructing a building or a building extension here in this example. So the customer because they own the building, now we're having an extension of the building, so they control that extension of that building over time, so we can recognize that over a period of time. And if the asset, the seller is creating an asset that has no alternative use, that's a good example here. Maybe Lockheed Martin is building a jet for the US Air Force. And so, nobody is going to use that jet except for the US government. And, I doubt the US government would allow Lockheed Martin to sell some jets. And so revenue is reckoned in proportion to the amount that the performance obligation has been satisfied. A lot of these will be systematic and straight line ratably over the period of time, like a rent of a facility. So it makes it rather easy. So here's an example. TriTech sells a 1-year subscription to the multi-user program. And so customers have a subscription to use their software, I would assume, for a period of 1 year. And they pay for that upfront, like you pay for airline fares upfront. And they've sold 1,000 of these subscriptions for $60 each. The company has received cash of $60,000, but yet they've done nothing for the customer yet. They're going to do that over the next 12 months, over a period of time. And so that's a deferred revenue. And we've talked about that in the past. And so this is 60,000 divided by 12. Each month, they are going to complete, 1/12 of that performance obligation, and they're going to recognize 1/12 of the revenue, $5,000 in revenue, and they're going to reduce their deferred revenue liability. So now, if the three criteria do not apply, and it's probably more of a rare circumstance, and you can even think of an example right off the bat, then you wait until the whole performance obligation has been satisfied at the very last day, and you recognize that when the last day when everything has been satisfied. Now, looking at this, how much of the performance obligation has been satisfied, you can look at either an output-based measurement or an input-based measurement. So output-based measurement may be how much of the asset we've transferred to the customer. And sometimes that may be hard to know if you're building a bridge or a building. How much have we finished? It's hard to kind of ascertain that. And so therefore, you may come back into an input-based. If we know our total estimated cost, then how much of cost have we incurred to date? So that would be kind of an input-based. We'll recognize that percent of the transaction price as revenue. And we'll see that. We're going to do some examples for that. So what if we have multiple performance obligations, not one? So step two, we're going to have to identify all these performance obligations, and then we're going to allocate the price to those performance obligations. And sometimes it gets a little bit fuzzy. Do we have 2 or 3 separate performance obligations, or is it just one performance obligation? And the best example is building a house. Do we have like 100 million different performance obligation for the roof, the air conditioning, the kitchen appliances, the floors, or do we just have one big performance obligation, a house? And so this is something that when the FASB was creating this rule, they struggled with. And in the construction industry was actually up in arms when they looked at these rules at first, because they didn't want to have to break down a house or a building into 100,000 different little tiny performance obligations. And so the FASB had to work on some guidance here. In the guidance we see here in the slide, so a good or service is distinct if it's capable of being distinct, if it's totally separate, and it's separately identifiable from other goods and service. And here construction contracts fails the separately identifiable, because when you have a house, the roof is not a separately identifiable. A house is a house, and so it is one performance coverage. So let's look at how we allocate the performance obligations. And we allocate based on the separate fair values of each of the performance obligations. So in this case, TruTech's going to kind of work a deal here, if you will, because remember they sold subscriptions for $60, and the individual boxes were $240 each. Now they're going to say, hey, I'm going to sell the customer both. You get a box and you get a 1-year subscription. You see this a lot, right? With Xbox and the Sony PlayStation. You see this where they'll sell you a box and they'll sell you subscription to some software, both at the same time. And so now we've got to allocate that, the company who's selling these has to allocate the price between the different performance obligations. So let's look at this example. So do we have a contract? Yes. Did I skip this? Let's see. Oh yeah, we're going to get there. I'm going to make sure I didn't delete this slide, because this is a really important slide. And so, yeah, so the TriBox, meets the criteria for multiple performance obligations, because there's 2 distinct goods and services: a TriBox module in a TriNext subscription. In fact, they sell these separately. That's a good indicator that these are distinct, because they already sold these separately, and now they're combining them into one. So definitely these are separate. What is a transaction price? It's $250, $1,000 times 1,000 systems, 250,000. But now we got a problem because we have two performance obligations. So we're going to look at, sorry about that. We're going to look at these performance obligations. The standalone price of a TriBox is $240, and the subscription is $60. So we're going to take, okay, how much of this $250 do we allocate to the module? We're going to see it's going to be 80%. Where does that 80% comes from? It's the $240 standalone price divided by the total of the standalone prices. When those total is $240 for the module and $60 for the subscription. Same thing with the subscription, $60 divided by the total fair value, 320%. We didn't sell it for 300, we sold it for 250. So we're going to take 80% as we calculated, and we'll record a one-time revenue transaction for $200 for the module. And then 20% of this 250 is going to be over a period of time. So look at how these having multiple performance obligations affects revenue recognition. It impacts the timing of when. And so those managers who want to recognize all this 250 now, they don't get to. They get to recognize 200 now, but this other 50 is going to be recognized over the next 12 months. We'll see in the future slide here. So the very first entry, we are going to recognize that 200,000 for selling 1,000 of those boxes, as we saw at the previous slide. And we're going to have deferred revenue for 50,000 of those. Now the customer pays us the 250, they owe us the 250 in accounts receivable. And here, over the next 12 months, we'll reduce the deferred revenue account with debits, and we'll credit the service revenue account. So this is a good slide. I think that there's a, if you're one of my students, you will see this in the textbook. So this is just a summary of kind of everything we've talked about. I hate to say it because I don't like memorization, but memorizing and understanding this slide right here, that is for, my non-students who are going to be everyone's going to be tested on this slide. Let's say it that way. So you really need to know this slide backwards and forth. Moving on, special issues. So we're going to look at some special issues here. Do we have a contract? And again, they can be implied, they can be oral, just a handshake, or they can be written down in a very formal agreement. And the contract only exists, it's got to have commercial substance, that there's a real transaction, a quid pro quo here. Both the seller and the customer have approved it and agree to this, and the rights and the payment terms, all that is really clear inside this. Even if it's implied, the payment terms have to be crystal clear in that. Now, this is one I don't think we've talked about, but this is an important criteria, and that is it's probable that the seller will collect the amount. Now, as we know from allowance for doubtful accounts and bad debts, the seller's not going to collect every single dollar in accounts receivable, but for every transaction, at the time they recognize revenue, they believe it was probable that the buyer will pay for these products or services. Okay, here's some things that are not considered performance obligations. Prepayments. So if I prepay for an airline fare, no performance obligation has taken place. Only the customer has paid cash to the seller. And so the airline company has done nothing. They've received a prepayment, not a performance obligation. If it's not a performance obligation, you do not recognize revenue. Another one that the FASB struggled with when they're coming up with these rules are warranties. So if a automobile manufacturer sells us cars, each car usually comes with a 3, 4, 5-year warranty, whatever. Is that a separate performance obligation? And the FASB has clarified that all the assurance warranties are not a performance obligation. So you would still recognize that product sell single point in time. You would also recognize the warranty liability, but you would not recognize part of that revenue over a period of time. And a lot of us are very happy to hear that, because it would be kind of hard to separate all the revenues out for all the products that are sold with warranties and then have 2 performance obligations. So there was a lot of celebration when the FASB decided that the warranties, that the basic kind of warranty that the whole industry provides is not a separate performance obligation. And then if the product is sold with a right of return, that is, that everything could be returned. That could be a failure to satisfy the performance obligation. And we'll get into rights of return later in this chapter. Now, these next 2 are performance obligations. And so let's look at extended warranties. So, maybe the car manufacturer, but we all know about car warranties because we're getting so many robocalls these days. Hey, your car's warranty has expired. Let us sell you an extended warranty. I am so sick of those calls personally, and they must be very profitable since everybody and his brother is trying to call you and sell these. So this is outside. An extended warranty is outside the normal warranty that the industry generally provides for that type of product. So if it was a 3-year warranty that you got with the original manufacturer, and even the original manufacturer might try to sell you up front that, here's an extended warranty, we'll warranty this thing for 10 years. And so it's outside, I like to think of it, it's outside of the standard warranty, a separate kind of warranty. And you have the option to purchase it separately. It's not part of the normal warranty that came with the product. And it's beyond just the normal quality assurance. It's going to go way beyond, hey, we've given you a good car and it's going to be good for 3, 4, 5 years. It's outside of that. And it's, much more like insurance, if you will. We're going to pay an upfront dollar amount to some warranty company, and they're going to provide us insurance that they will take care of our car over time. So these extended warranties, unlike standard warranties, they are considered a separate performance obligation. And so that would have to be looked at as a separate performance obligation. And that would be satisfied probably over time, because the warranty is going to be provided over some term, 5, 10 years, whatever. And if the customer receives some kind of option, a right to receive something that they would not be standard, and I can't even think of an example of this right now, that would also be considered a performance obligation. If I can think of an example, I'm certainly not going to test my students on that. There's some other things that we have to consider. What if it's variable consideration? That customer is going to pay us, different amounts depend on future circumstances. That can happen, so we've got to consider that. What if we have a right of return? That we're going to look at this. And then, is the seller a principal or an agent? You have to think about time value of money and any special payments by the seller to the customer. So let's look at each of these. So variable consideration in construction, if you have an incentive payment, if you finish the building on time, healthcare reimbursements. I'm not a big expert on those. Volume discounts, I have seen that where if we manufacture products at Maytech for our dealers, and if they bought X amount of washing machines and dryers and refrigerations, if they bought and each customer had a different kind of target, but let's say if they bought $1 million during that year, we give them a 10% volume discount. If they didn't get to that $1 million, they didn't get the discount. And so that was an incentive to get our retailers, our dealers, to sell more of our appliances, and more of our appliances versus someone else's. And so you got to the end of the year, we would get a lot of purchases from dealers trying to make their volume discount and get their discount, and it would be retroactive to all the sales from the earlier in the year. And so we have to estimate kind of the expected value that we're going to pay out for that, or maybe receive if it's an incentive payment. This was a discount, and we're going to predict that, and we're going to reduce or increase the revenues based on what we expect will happen in the future. So we will record that upfront based on what we expect. Right of return. Now, if the customer can return the good, if he's unable to resell it, then that's a serious issue. We cannot recognize revenue. We haven't really we really haven't transferred the total risk of loss to the customer if the customer can just return it if he can't sell it. So that's just not, we would then have to recognize revenue when the customer themselves sold that product. But if we can estimate, future returns, this will be, now the one exception I'll say to what I just said, if we give customers a right of return and we know that returns equal 2% or 5% of future of our revenues, then we will reduce the net sales in the income statement, and we will do an estimate of future returns. And so here's an example. TruTech sold 1,000 try boxes for $240 each, and they know from history, hey, 5% of these will be returned to us. So what happens? We are only going to record revenues of $228,000, and we'll still put receivables at $240 and a revenue at $240, but we're going to have a return allowance of $12,000, and we'll set up a return liability, if you will, for $12,000. So there's a bit of complexity around that. Sorry, I'm losing my voice today. Got allergies, so I'm trying to drink water and get through this lecture, but we will do that. So another challenge is the seller a principal or an agent, and I'm going to just skip by this and go right to a good example of this. Here's one. The Princo purchased the Tri Box for $240, has the modules shipped to his distribution center, and then sells them to a customer. Here's another one. They're just a web portal, like an eBay or like Amazon, when they're just the go-between, and they never take title. This agent code never takes title. They're just facilitating the transaction between two parties. And so the manufacturer ships directly to buyers only when the sale is made. And agent code, they just get a $50 commission. So they never actually got title to the product. And so they're considered an agent. So, and the only difference here for both Princo and Agent Co, the creative names here, the gross profit, their profit's going to be $50. This one bought them for $240 and sold them for $290, but they took title to them. So their profit's going to be $50. Here, their profit was $50, but they never took title. They never had to buy the products. And so the issue here in the principal versus agent, challenge here, if you will, is how much revenue are we going to record? The profit's the same, but here the principal records $290,000 in revenue, but here only $50,000 in revenue, but zero cost to get to a gross profit. This company took title of the inventory and had the risk of loss and recorded it as cost of goods sold. So This would be a what I would call a grossed up income statement with all of the revenue. Now, why do we care? Because the profit's the same. Well, the revenue is far less. And so most companies are going to want to be considered principals so they can record a larger revenue amount. Now, if you're an auditor and you're looking at their financial statements and you're looking at their transactions and you see someone record it this way, you might challenge them and say, you never even took title of this. Seems to me more like you're an agent. And so this would be important because users of the financial statements, they care about how much revenue is recorded. That matters. And so 290 versus 50. And so as an auditor, you could come back and say, yeah, you get the same profit, but we're not going to allow you to record all of that as revenue, those transactions where it appeared that you were an agent. And sometimes, we may sell a product and receive a note receivable for it. And so there could be a financing portion of that product. And then that, I'm not going to really test my students on this, but just to note this, we may see this later when we do note receivable, but there could be a financing component for the transaction, meaning there's going to be some interest involved, and we may have some interest revenue associated with this. Some other performance obligations that some arrangements we have to think about: licenses, franchises, bill of hold, consignment, and gift cards. So let's look at each of these. So if someone has sold the customer a license to use intellectual property, that means you will recognize revenue on that. Now, it could be recognized at a point in time if it's a one-time deal, or more likely, it's going to be over the license period. A good example is Apple Music licenses all of the music from the people who created that music, and then they sell us subscriptions, so we get to listen to that music on Apple Music or Spotify, which most of you probably have Spotify. I like Apple Music, but they are going to the music providers, the artists who created that music, they're selling a license, and they will recognize revenue over a period of time. Franchises, this would be, think McDonald's, Subway, they are selling the right to their brand to owners who own the franchise to a Starbucks. I mean, not Starbucks, because I don't think they franchise. Subway is the most common one, where a lot of people become franchise owners of Subway stores, and they get a certain geographic area that they can build Subway stores there, and they're going to pay a one-time fee for the store, the branding, the signage out front, pay a one-time fee, and then usually an ongoing fee as a percent of sales to use their products. And so there's another type. So for Subway as a company, they're recognizing revenue from their franchisees. This is one that I generally just hated as a corporate controller, because everybody and his brother would come at me and say, hey, I've received X millions of dollars from our customer, but they can't take our product yet. So we're just going to hold it in our warehouse, and they pay for it. And they'd always say, hey, even the title is passed. But big question, has the risk of loss passed? Have we delivered the product to our customer if it's still sitting in our warehouse? And so my answer always was, hey, I like cash, collect the cash, but I'm sorry, you cannot recognize revenue until that is delivered to the customer. And generally the customer didn't have room for it yet, and they will take it when? In the next accounting period. And so I had a lot of sales guys very upset with me because they couldn't get their sales commission because we were not recognizing revenue in this accounting period. Now, whenever that product's delivered, we'll recognize revenue then, and the Mr. or Mrs. Sales guy person can receive their commission on the product, and our income statement will have that revenue. And so I saw this a lot, especially towards the end of the year when people are trying to make their numbers, bill and hold sales. And there have been a lot of fraud around bill and hold. And I won't get into the stories, but you can look up Al Dunlop and Sunbeam, who they built a whole bunch of grills for Kmart, which is like a Walmart way back in time, and recorded their revenues. It was like next summer's grills, you know, so they record all of next summer's grills in this summer, you know, wrong. How crazy is that? And so the rules, so I want to like point here, you know, if you're in my class, you're getting a multiple choice question on this because I am so passionate about it. So revenue typically should not be recognized until actual delivery to customer occurs. And I don't care if title is passed, I don't care if you got all the cash in the world up front, no, only when the product is delivered to the customer. Now, consignment is very different because we may provide a product to a retailer on consignment, and we still own the product. It's still our inventory. I wouldn't even say it's right of return because we could just go get the product out at any point in time. We're putting it in their showroom on consignment. Now, this is really important. You cannot recognize revenue on consignment until that product is actually sold to a third party. And so, because you still have legal rights. Now, where you see this in practice with a lot of manufacturers, they have a lot of consigned products out on display in showrooms, in retailers' showrooms, and you have product out there so people could see the product, and that's a consignment still owned by the manufacturer. And the retailer doesn't want to pay for it because they're using it as a showroom to try to sell your product. You know, why should I buy this? I'm helping you out. It's in my showroom on consignment. And so until that product is sold, that is, you know, to an outside customer, there's and legal title is passed. Until that happens, you cannot recognize revenue. Gift cards. So, oh my God, how many gift cards? I probably have right here in my desk here at home about 10 or 15 gift cards I've received as presents. And, you know, I've got to go use those. Maybe it's Saturday, maybe I'll think about using one tonight. But, you know, let's say if I buy a $25 gift certificate for Chili's, one of my favorite places to eat, especially for takeout, is Chili's. And so, you know, has Chili's given me any food yet? All they give me, I think I might have one, maybe not here in my desk right now. I bet I have a Chili's. Let's see if I have a Chili's. Now that I've made the effort to find one, I probably won't find one. Oh, Chili's right there. Can you see that? Oh, Chili's upside down. Chili's, Dick's Sporting Goods, you know, I've got Brooks Brothers. I've got a lot of gift certificates here. And I'm very grateful that people gave those to me. So don't think that I am not, and I will definitely use those. But let's just think about that Chili's gift card that I just showed you. Have I eaten any food at Chili's yet? All I've got is that card. And so when I'm ready to order from Chili's, I'll go down and give them that card and say, hey, give me some food. They say, well, I'll pay for it. Oh, here's your gift card. And I don't have to pay for it. So what does that mean? That's really like a deferred revenue. I have paid 25 bucks and I've got this card. Chili's has received my 25 bucks, but now they owe me food. So it's a deferred revenue. Same thing we've said. They're going to debit cash for receiving a gift card, and they're going to credit a deferred revenue liability. Now, when I use that card, they're going to debit their deferred revenue, as we've seen, and they're going to credit real revenue for the food they provide me. Lots of disclosure around this chapter in the footnotes. You got a disclosure, bad debt expense, all your contract liabilities, contract assets. We'll look at some of that. You know, if you have outstanding performance obligations, you may have to quantify those in your footnotes. So there's, if you look at the revenue footnote, you're just going to see a ton of information there. Okay, we're heading towards home, but this time, you know, the end of my slides, the end of the chapter, the end of my presentation with my hoarse voice. However, we're not going downhill. I wish we were. Downhill right to home, it's all over. We're going to be climbing a big hill. This is a hard part. And for my classes, they will receive a problem that they'll have to work on long-term contracts. And why do I think it's so important? There are just so many businesses that have contracts these days. And so, especially here in Dallas, where I am, look at all the buildings, bridges, roads are being constructed, you know, they're related to long-term contracts. And so those construction companies are recognizing revenue as the work is being performed. So it gets hard. So let's take a look at this. So here's the Harding Construction Company, and they're going to build an office building for $5 million. By the way, it's not a quick build. They're going to take 3 years to build this in 21, 22, and 23. According to the contract, Harding will bill the buyer in installments, that's misspelled by McGraw-Hill, over the construction period according to a prearranged schedule. So let me try to think of, see if I can put this into one, two, three. I'd say kind of three things are going to happen. The company is going to be incurring construction costs over time. One, two, the company is going to be recognizing revenue for how much of the work that gets performed over time. There's two ways to do it: percentage of completion over time, or wait till the end. So that's completed contract method. And the third thing that is totally disconnected is they're going to bill the customer along the way. Now, how much they bill, especially in our examples, is going to be distinct. It's going to be a separate kind of transaction from how much work is being performed. And so we're going to have to account for construction costs that have been performed, how much is in accounts receivable, and how much have we billed over time, and how much cash have we collected over time. So there's a lot of moving parts here. Let me warn you. So let's look at these three areas I kind of just talked about. So all of these journal entries are going to go back. And I believe this is, if you're one of my students, you have the McGraw-Hill textbook, you can follow this, but this is the facts. So construction cost, $1.5 million, $1 million, $1.6 million, billings, $1.2 million, $2 million, $1.8 million. And so that's where these entries come from. So as they're incurring costs, they're crediting cash and materials, and these are the costs that they recorded each year. And we place this in something called construction in progress. And so this is an asset now, that because you know, we're building this bridge, it's really our asset. That's a construction in progress, all these costs that we've incurred along the way. And this was just how we agreed contractually to work with our customer. We're going to bill them based on the terms of the contract. And so it's totally different than amounts you see and costs that we've incurred. So we're going to bill them $1.2 million, $2 million, and $1.8 million. Now, I'd like you to think of I call this a CIP account as an asset. Well, these billings is kind of a contra asset. It's a liability because now they've given us cash, kind of we owe them. And so you're going to see later, we're going to net this CIP account, this billing account, and that's going to go onto our balance sheet as an asset if our CIP account is larger, or a net liability if the billing account is larger. So that, just to kind of help you think about that. And so we're also going to receive cash, which also may be different than what the receivable is. They only paid us $1 million of the $1.2 million. I don't know why. They paid us $1 million for this year, and finally $2.6 million. Now look at the billings, $1.2 million plus $2 million, that's 3.2 plus $1 million, that's $5 million. What was the price? $5 million. So this is what we agreed as the contract price was 5 million. And then along the way, we're gonna bill them. We don't wait till the very end because, man, we're incurring all these costs. They get, that would be unfair to us unless we're going to charge more, because we'd have to go borrow the money potentially to have all these costs. So that's why we have billings along the way. And then, by the way, the cash payments are also, this is also equal to 5 million. And so we'll see how we account for this. And my next lecture on this subject, I will work problems on this percentage of completion method. And I think I worked 2 or 3 of those. And so once you get through this lecture, you can see how I work those problems. And I will, for my students, be working those in class also. Now, there's 2 ways, as I said, to recognize this. We could just recognize everything at the very end, last day, revenue from 5 million, or we can recognize revenue along the way. How do we recognize revenue along the way? And it's different than billings. Don't think billings here. This is revenue. How do we recognize revenue? We recognize revenue for the percentage of our performance obligation that has been satisfied. And so we've got to measure some way this percent. So in this case, we'll see this measurement in a minute, but here it's already, the numbers are given to us. So they're going to recognize 2 million of revenue and 1.5 million of the cost. We saw that construction in progress, 1.5 million. And then this is what's going to be the gross profit. And so it's a little bit weird because on our income statement, we'll have 2 million minus 1.5 million, we'll have gross profit of 500,000. And so this is going to be kind of counterintuitive here, because usually gross profit just goes away, you zero it out, it goes into retained earnings. But here, because we have not delivered this building to our customer until the very end, we're going to take and put this gross profit in our CIP account. And so that's a difference between these two, and that gets recorded every single time. And so here, again, either whether we recognize the revenue over time or at the end, it's still 5 million. So this is about timing. And so here, the total gross profit in the CIP, was 900,000. We recognize 900,000 over the total. And this is recognizing revenue upon completion, which it might be a little bit easier. And then we're just going to zero out the CIP account and the billing account. And we'll take a look at it. But I'm going to move to percentage of completion. I'd say maybe a little bit harder. Once you know percentage of completion method, you can go back and look at a completed contract method. You'll get it. It's just doing all the same stuff, but you do it at the end. But I'm going to do percentage of completion here because, and I'm going to test my students on the percentage of completion. Well, it's harder. Sorry, and I want you to be challenged, and I want to get that analytical skills, that critical thinking skills. I want to get that going for you right now, because this is the time you're moving into the core accounting subject here, intermediate accounting. And so we're going to recognize revenue, based on how much is done. So at any point in year, the first year it's easy because you just recognize how much percent did we complete. What's the total price? We recognize that. In the second year, it's a little harder. We're going to recognize the cumulative. Where are we along the way? And recognize that percent. But then we got to subtract out what we already had recognized in previous periods. So we just get the revenue for this period, kind of the additional performance obligation that's then met. All right. And as I told you, intimidating. Right? You look at this slide. Oh my God, I'm out. It's intimidating. And I really want you to not memorize this formulaically. You've got to understand the logic. And if you understand the logic, this will be easy for you. So in the first year, 1.5 million, and now we have to estimate what are the total costs to complete. So this is at the end of the first year, and we may be wrong here, by the way. And we'll see examples of what happens when we're wrong. But right now, we believe the total cost to complete will be $3,750,000. How much have we done so far? $1.5 million. So this would be kind of an input. We talked about looking at output measurements or input measurements to see how much of our performance obligation has been satisfied. We use inputs here. And so $1.5 million is how much we've spent to date on this year, because it's the first year. And the total cost was $3,750,000. So we're going to say, hey, we're 40% done. For the $1.5 million work input, total input, what we expect the total input to be $3,750,000. Again, that's how much we've had cost to date plus what's left to do, $3,750,000, and that's 40%. So what we say at the year one, hey, we are 40% done. What was the price of the contract? $5 million. So I'll recognize now 40% of that price because 40% of my performance obligation has been satisfied. What's 40% of, 5 million? 2 million. Same thing, year two. Now we had costs occurred during the year of $1 million, new cost in year two, 2022, $1.5 million. So now we're at 2.5 million of cumulative cost. How much we have left to go? $1.5 million. Hey, look at this. Our total cost estimates have now gone up. What does that mean? We're not going to make as much money as we wanted to, because we thought we'd be $5 million price, and it only cost us $1,375,000. Oh, got a surprise here. Bad surprise. Only $4 million. But right now, we're just trying to recognize the revenue. So we say, hey, total cost to date, last year and this year, $2.5 million. Total cost for the whole project, now we're estimated $4 million. Now we've got 62.5%. And so we should, at this point, have recognized $3,125,000. And I think it's the next slide, but I'm going to show it to you now to make it easier. How much will we recognize for revenue in 2022? Well, cumulative revenue at this point, based on how much of the performance obligation we've satisfied, should be $3,125,000. We recognize $2 million so far. So this year we're going to recognize $1,125,000. By the way, the last year is pretty easy because now we're at 100%. Project's done. We've completed it. It did cost us more, $4.1 million, but now we're just going to recognize the rest of that $5 million. So we'd recognize in this year $5 million times all the cumulative costs recognized in previous years. And I think that's what we'll see on this next slide. Yeah, right here. So here was 2 million cumulative revenue recognized, 3.125, and then 5 million minus what's previously been recognized. So in this year, we would recognize $1,125,000, then $1,875,000. What's the journal entry we're going to do? Revenue from contracts, 2 million, and this is the cost of goods sold. Go back to what is this $1.5 million? That's the construction cost we incurred this year. And so that would be just like a manufactured product. That's our cost of goods sold, $1.5 million. So these two items end up on our income statement. What's our gross profit? Sales minus cost of goods sold. It's going to be $500,000. But our journal entry, by the way, just to make it easy, our journal entry has to match. Our debits and credits have to equal. So we got to do something with this $500,000. And we put this in, it cannot go to retained earnings yet. This $500,000, it's got to go in the construction in progress account. We haven't delivered this building. So what's going to be in this construction in progress account at any point in time are all the costs we've incurred to date, plus the profit that we recorded. The next year, $1,125,000 minus $1 million. So we made a gross profit in all 3 years. And so let's just look at this here. And they're just noting, here's these gross profit amounts. And you can see, we recorded in CIP each of these construction costs. We also put the CIP in there. And so let's just look, here's the ending balance of 2 million in our CIP. That's considered an asset. Now, along the way, go back to that very earlier slide, we were billing the customer. We had some interim billings. They have no bearing on what our costs have been. Those billings are all about what we contractually agreed to pay them along the way. They have no bearing on revenues. So you have to kind of get your mind straight around this. These billings are really deferred revenue, if you will, because it's cash up front and we owe them a building. And so on our balance sheet, we have a $2 million asset and $1.2 million liability. What's going to happen? We're going to net these. And it's going to be an $800,000 asset. Same thing here. Ending balance is $3,125,000. And the ending balance, because we billed them another $2 million, is $3.2 million. Now our billing account is greater than our asset account. So we're going to have a liability. We'll see that probably in the next slide right here. Here's the income statement that I talked about. So you got gross profit each year. This is the what will show up on the income statement each year. And at the end, we are going to take and zero out our billings account and our construction and progress account. And so remember this billings account had a credit balance because it was a deferred revenue, and this construction and progress had a debit balance of 5 million. We're just going to credit that and debit that. So that's just the, closing out the contract and being done. But here's what I wanted to show you here, because and you're going to be responsible for this in my class and probably in your class if I'm not your teacher. And so what's going to show up on the balance sheet? In 2021, we're going to have a $200,000 receivable, because remember, we billed them $1.2 million, but they only paid us $1 million. So they still owe us $200,000. Not related to billings account at all. That's a whole nother thing we're tracking. And so the CIP account has $1.5 million, and the billings account only has $1.2 million. So here we have a $300,000 asset, just netting. Basically represents the fact that we have more construction costs and profits than we billed the customer. So it's an asset. They're going to owe us another $300,000. Oh, yeah. And so this is for when profit revenue is recognized on completion. It's going to be maybe a little bit different than some of those numbers, but it'll be similar. So in year 2, the billings account had 3.2 million versus 2.5 million. The CIP accounts of 700,000. Now this $1.5 million is different. This does not include, not to correct what I just said, because I don't want to redo this entire 1 hour plus lecture. This area right here is for, when you're recognizing revenue upon completion. So the CIP account has no gross profit because we haven't recognized revenue. We don't recognize revenue until the very end. And so, and if I go way back, you see how hard this chapter is going to be. I'm going to go all the way back to here, recognizing revenue upon completion. We just do one journal entry at the very end and recognize 5 million on the very last day when that building is done. And that's called, I call it the completed contracts method. Here they call it recognizing revenue upon completion. So this gross profit was not recorded in 21 and 22. However, in a percentage of completion method, we recorded revenues each year. And so we had a little gross profit each year, which got put into that CIP account. So hopefully that helps come back to where I was all here. And I just think it'd be really hard to get this. I don't care if I was the greatest lecturer in the world, which I am not. I got that, I acknowledge that. But even if I was, you're not going to get this from this lecture. You are going to have to pull your textbook out and follow this all the way through from cradle to grave and understand the ins and outs. Guarantee you. Or hopefully it will help you when I when I do the problems in the next lecture, which I'll report. So point being back here we only have in the CIP account $1.5 million under the completed contracts method, but we haven't recognized revenue. Look at here where revenues over time, the CIP account has $2 million because it's recognized, some of that gross profit. So again, we're going to net our costs and our billings account. And in 2021, even here for completed contract method, the costs are still greater. So we've got a $300,000 asset. Billings is a liability account like deferred revenue because they paid us when we billed them, and costs are costs that we've incurred. So we have more costs than billings, so we have an asset. In year 2, that's not true because the billings are 3.2 million. And so we build them more than what it's cost us. We get a $700,000 liability. Here in the revenue recognized over time, notice how accounts receivable has not changed, because that's related to how much we bill, credit billing, debit accounts receivable. And so that is totally disconnected from the billings and the cost accounts. It's a separate area that you have to kind of think about here. And so here, now we have gross profit in there and, versus the $1.5 million. So our cost is $2 million. It's even greater by 800,000 versus that 300,000, $1.2 million. So we have an $800,000 asset. But at the end of year 2, our billings are greater than our CIP account, 3.2 million versus 3,125,000. So therefore we have a $75,000 liability. And I get it. I rushed through that. I jumped around a little bit. This is hard. This is where you need your textbook. This is where you have to actually do problems and work it in accounting. And I'm going to work 2 or 3 problems in the next lecture, and you're going to have to work those problems also. You're going to have to get down pen to paper and work this, and then you'll internalize. I think you'll get it. You might even want to draw out some T accounts and see how these accounts play out. Now, and now we are at the end. If in the earlier years, year 1 or 2 in this contract, if your estimated total cost to complete the project are greater than your price, what does that mean? Number one, that is a big problem because now you probably didn't price this deal outright, and whoever your FP&A person was for your business, they are going to be sweating bullets now about their job because they estimated a certain amount of costs. Now the costs are a lot greater than we estimated, and we could see in the future and say, hey, this contract's going to be a loser. Well, when a contract's a loser, you recognize all the loss the year, all the future losses the year it's a loss. And this is kind of back to the principle of conservatism for accountants. We recognize losses faster than we recognize gains. And so I'm not going to do the periodic loss, just the overall loss. So here's an example of this company. So same company, but a little bit different numbers here. Year 1, we still think total estimated cost to complete $3,750,000. Remember, the price is $5 million. So here we say, oh well, we are going to make. This is a winner. This contract, we're going to make $5 million in total minus cost of $3,750,000. So we're going to make $1,250,000. Good news. Therefore, in year 1, I'm going to go ahead and recognize. This is revenue recognition over time. A gross profit of $500,000. Remember, my revenue was $2 million minus my construction cost of $1.5 million in this. So I am recognizing revenue over time, $500,000 now. Recognizing revenue on the very last day upon completion, obviously there was 0 there. Now, here's the problem. Year 2, now we estimate, oh my God, this is a big change. You went from estimated cost of $3,750,000 to $5.1 million. But I'm not allowed to raise the price to the customer. It's locked in. We're in a lot of inflation right now in 2022. This could be, a lot of people could be experiencing contract losses right now because the price is set by contract, and not, many companies will not be able to raise price. And so here we know that right now we think we're going to lose 100,000 on this contract. So upon completion, it's easy. We had 0 recorded last year. We got to go ahead and recognize that $100,000 loss now. Well, look at here under the overtime method. This year, we're going to recognize a $600,000 loss. Why is it different than the 100,000 under the in last day completed contract method? Well, we recognized 500,000 of income last year, which is not going to happen. That's gone, because now we're going to lose money. So we get to a cumulative basis of the $100,000 loss. So we have to account for the fact that we recorded $500,000 of income last year, and we've got to do a $600,000 loss this year. So the net cumulative answer is a $100,000 loss. And then the final year, costs go up again for another 100,000. We have another $100,000 loss in the next year. That's the main point of this slide, is you're always looking out in the future for total costs. Number one, you're doing it so you can see, hey, how much percent are we complete? If you're in a percentage of completion method, so I can recognize that portion of revenue. We're also looking at total cost in the future to see if we're going to have a loss on this project. And if we're going to have a loss, we have to recognize all of that total contract loss now on a cumulative basis. And so I'm not going to get through this. So that's it. End of chapter 6, end of revenue recognition. Man, I get it. It's a bear. It is definitely a beast. And so I'm sure you guys, if I don't do anything else, get you to pull that textbook out and follow through what I just did there. And maybe do that before you see me work the problems in the next slide. Again, thank you very much for bearing with me it's a Saturday afternoon for me. It's cold outside, so that's why I'm in here recording lectures. And I just wish you guys the best of luck in your intermediate accounting class.